Mutual funds are a popular investment option. They offer diversification and professional management. A mutual fund pools money from many investors. It then invests this money in a variety of assets. These assets can include stocks, bonds, and other securities. This diversification helps to spread risk. Imagine a basket of fruits. Instead of putting all your eggs in one basket, you have a mix of apples, oranges, and bananas. This represents the diversified approach of mutual funds. Each fruit is a different asset class. Mutual funds are managed by professional fund managers. These experts make investment decisions on behalf of the investors. They use their knowledge and experience to select the best assets for the fund's investment objectives. This professional management takes the guesswork out of investing for individuals. In essence, mutual funds provide an easy and accessible way to invest in the financial markets. They are suitable for both beginner and experienced investors. They offer a convenient way to achieve financial goals. There are various types of mutual funds. Each type comes with its own risk and return characteristics. Understanding these differences is crucial for choosing the right fund. Equity funds invest primarily in stocks. They offer the potential for high returns over the long term, however, they also come with higher risk. Bond funds, on the other hand, invest in bonds. Bonds are less risky than stocks. They offer lower returns compared to equity funds. Hybrid funds, as the name suggests, invest in a mix of stocks and bonds. They aim to provide a balance of risk and return. Index funds are a type of mutual fund that tracks a specific market index. For example, an S&P 500 index fund would aim to replicate the performance of the S&P 500 index. Other specialized mutual funds focus on specific sectors or themes. These might include technology funds, healthcare funds, or emerging market funds. It's important to diversify your investments across different types of mutual funds. This will help manage risk effectively. Choosing the right mutual fund is crucial. This decision should align with your financial goals, risk tolerance, and investment horizon. Before investing, determine your financial goals. Are you saving for retirement, a down payment on a house, or your child's education? Consider your risk tolerance. How comfortable are you with the possibility of your investments fluctuating in value? If you're risk-averse, you might prefer lower-risk funds like bond funds. If you're comfortable with higher risk, you might consider equity funds. Your investment horizon is another critical factor. This refers to the length of time you plan to hold your investments. Longer investment horizons allow you to take on more risk. You have more time to recover from any market downturns. Research different mutual funds thoroughly. Look at their past performance, expense ratios, and the fund manager's track record. Don't solely rely on past performance. Remember that past performance is not indicative of future results. Section 4. Taking the leap. How to invest in mutual funds. Investing in mutual funds is a relatively straightforward process. You can invest through various channels, both online and offline. Online platforms such as brokerage accounts or robo-advisors offer a convenient way to invest. You can open an account online, complete the necessary KYC, or know your customer requirements, and start investing in a matter of minutes. Offline, you can approach banks or financial institutions that offer mutual fund investments. Before investing, you'll need to determine the amount you want to invest. Mutual funds typically have a minimum investment amount. This can vary depending on the fund. You can choose to invest a lump sum amount, or you can opt for a systematic investment plan, commonly known as SIP. SIPs allow you to invest a fixed amount regularly. This could be monthly, quarterly, or annually. This disciplined approach helps average out the cost of investments over time. It's especially beneficial during market volatility. Section 5. Monitoring your investments, the key to success. Once you've invested in mutual funds, it's essential to monitor your investments regularly. This doesn't mean checking your portfolio every day. It means reviewing your investments periodically. Make sure they are still aligned with your financial goals and risk tolerance. Keep track of the performance of your mutual funds. Compare their returns to relevant benchmarks. If a particular fund is consistently underperforming, it might be time to consider switching to a different fund. Rebalancing your portfolio is another crucial aspect of monitoring your investments. Over time, the asset allocation of your portfolio might drift away from your original target. This can happen due to market movements or changes in your financial situation. Rebalancing involves selling some assets and buying others. This brings your portfolio back to its desired asset allocation. This ensures that your investments remain aligned with your risk tolerance. Investing in mutual funds can be a rewarding experience. It's a great way to grow your wealth over time. Remember to invest wisely. Choose funds that match your financial goals and risk tolerance. Monitor your investments regularly. Stay informed about market trends. With patience and discipline, you can achieve your financial aspirations.